Good morning. It's August 6th, 5:33 a.m. Welcome to episode 12. Happy summer to you, Wowie, and to each and every one of our listeners. It has been a good and steady week in Wall Street as we get to witness the most awaited IPO listing of the year, the Robinhood IPO listing. Also, we have Square announcing its large bet on the buy now and pay later business. In addition, we noticed the contrary investor sentiment and the money flow that is ongoing in China markets. Furthermore, we had Bernard Arnault, Louis Vuitton's chairman, beat both Tesla's Elon Musk and Amazon's Jeff Bezos to become the world's richest man. A change in the guard, even just for a day. I hope you, our listener, have had a great and productive week and have benefited from the stock market rally. This is your host, Mark Yu.
And this is Wawi Santos from the Smoky Mountains.
All right, welcome to the Mark Yu and Wawi Show. A disclosure, this show is made for sharing information purposes only and not to be considered investment advice. We record once a week. I and Wawi are both physical therapists here in the USA with the same passion and interest in researching and investing our hard-earned money in the stock market. The show's goal is to share and learn from each other, answer questions, and provide informed investment decisions to our fellow listeners and coworkers in the medical field. And for those who are colleagues, thank you for your hard work. We are available on YouTube, Spotify, and Google Podcasts. On our previous episode, we discussed the incredible earnings performance of big tech companies such as Google, Facebook, Amazon, Microsoft, and Apple. Don't worry, guys, we're not going to discuss these companies all over and over again in this episode. We also talked about the trillions in cash laying around different companies' balance sheet, waiting to be deployed for better returns. We also talked about the coming slowdown in earnings in the following year, this 2022, that Wall Street already expects. It's going to be from 40% in estimation this year down to at least 10% by next year. Lastly, we also presented facts that would make you even more bullish in this crazy all-time high after all-time high record-setting stock market. For those who have missed it, feel free to go back and listen to it. Thank you guys for your support by subscribing and liking. All right, on today's topics, we have what's up on Wall Street, market industries and sentiments, the fear and greed. We have a brief stock discussion about Alibaba, a couple of clips from famous Wall Street personas, and our quote of the week. So with our what's up with Wall Street, we're gonna start with Robinhood. So Robinhood finally enlisted their stock or their company in the stock market, and from what turns out to be a warm reception, turned out to a quick bust. But still, I would say they've done pretty good. They're still up 45%. The thing is, for those who haven't been following closely this IPO, I noticed it did a rampant buying activity just a couple of days ago. For one day, it shot up at least 60%. It had to be halted because a lot of people were trying to get into the stock. And then just yesterday, it dropped by 28%. So quite a wild ride over here that has happened on the market in terms of IPO listing of Robinhood. And now, in comparison, I've pulled up the chart here comparing Robinhood with other brokerage companies. So at this point of time, as of yesterday, market close, Robinhood is now at 58.8 billion in terms of valuation. It's a lot more, twice as much, even a little bit more than its competitor Interactive Brokers, who have a lot of definitely user accounts as well. Also on the side, you would see Charles Schwab, which has engulfed or swallowed TD Ameritrade, one of the leading brokerage firms here in the US, just a year ago. So for Hood or Robinhood, now it's trading at almost 59 billion. IBKR has left behind at 26 billion. Charles Schwab, it's at 128 billion. So if Robinhood can, continuously show its growth and user count and also like investment accounts. I think on average they only have about $5,000 per account compared to Charles Schwab's 50 to $100,000 investment user accounts. So it's still quite a ways to go, right, Wowie?
I think so. Yeah, I
There's
agree.
there's still a long way to go for the for Robinhood to capture this market, and Morgan Stanley as well, who like acquired E Trade, which is also one of the leading brokerage firm. But Morgan Stanley is a different animal. Like it competes with Goldman Sachs and all of that. So their valuation at 176 billion is quite a feat to be reached if Robinhood gets to that point. Briefly here, we have COVID cases still climbing. On this chart, it said that the European Union is on its track to face its third wave, indicating that as of August 2nd, it efficiently now is reaching new peaks. Not as high as previously, but it's definitely on its way there. While the US, in comparison, is at least slowly dying down, which is a good sign because it's troublesome. It gave some trouble. The COVID Delta variant, actually, the word itself scared the stock market indices, at least last Monday when it started like falling. And here's the Bloomberg Billionaire Index as of August 5 or yesterday. We're looking at Jeff Bezos, Elon Musk, and Bernard Arnault. So right now, it looks like Bernard Arnault is back on his position at top three, whereas just a couple of days ago, he was for once the richest person in the world. So just to give you guys some information about Bernard Arnault, he's age 72. He got his start. He's a French investor. At this point in time, he's the third richest billionaire. He's a centi billionaire because his net worth is around 178 billion as of yesterday. Um, he is the chairman and CEO of Louis Vuitton, who owns a lot of other products, as you can see in this graph right here. It owns Berluti, Louis Vuitton, obviously, Christian Dior, Fendi, like all
Mhm.
classy names, I would say upscale type of brands or purse bags. Um, and not so recent. I think it was just recently, right? Last year, just before the COVID struck or the lockdown struck, Louis Vuitton acquired Tiffany as well, a well-established luxury brand here in the US. So at least for one day, he became the world's richest. I looked at the Louis Vuitton's numbers, Wowie, and looks like they did a good amount of business at least since January of this year to July. They reported um, an increase of sales or an increase of profits. So this is what we're looking at, like the bottom line after net expenses, marketing expenses, employee expenses. Their bottom line, their profit rose by 400% from last year. So that's 7.6 billion euros. Not bad for Louis Vuitton or luxury products maker who owns not only Louis Vuitton, but those products that we just mentioned, including Tag Heuer watches and Dom Perignon champagne. So definitely, people are spending big money in this recovery.
Well, we'll
Um,
expect more buyers of Louis Vuitton products with a lot of people uh, with their pockets filled,
right.
you know, with
Hmm.
money. New rich are constantly being produced this year. I think this year has produced more millionaires than any other year.
Hmm.
Just comment if I'm wrong.
Right.
Um, Louis Vuitton price,
Hmm.
it's available, on the stock market,
Right.
both as an ADR or if you
Hmm.
want to buy it directly with the ticker LVMHF.
Uh-huh.
And current price right now is 825. A year ago, it was at 406.
$8. Wow. So I mean,
825.
oh, 825. Oh, good. That's
Mm-hmm.
a good amount.
It was 406 last year, so it doubled.
Right. So this is
Ex-
the ADR. For our listeners, it's a call also known as American Depositary Receipts. So it doubled within the past year, looks like.
yes, yes, it did. And I'm thinking it may gain some more this year because I don't think we've seen the spending part of the cycle yet.
Mm-hmm.
Right
Oh, yes.
now, a lot of
Hmm.
people have saved.
Yes.
I'm gonna give it at least two more quarters, in
Right.
just my opinion.
Yes.
Just comment if I'm wrong. But I
Hmm.
guess we'll find out in
Yes.
6 months.
So what's good about this, Wawi, as you have mentioned, is we're gonna tackle this in a little bit. Like, where are we in the market cycle? Howard Marks, he just had an interview a couple of days ago where he had pointed out where are we exactly in the market. Well, not exactly, but his thoughts are in the market. And you'll be surprised for those who are thinking the like negatively about the market. You'll be surprised what he said. But yeah, definitely a good amount. Like just to go back to the ADRs for our listeners. So Louis Vuitton is headquartered in Paris, France, or how do you say Paris? So it's
Paris.
so they're located there. So their stock is listed in a foreign market. So the way that they go about it being listed here in the US in order for US investors to buy their stock is they list to over the counter or through ADRs, so American Depositary Receipts. So you get to buy them still, buy a share of the company and benefit from the dividends and whatnot. So not a whole lot of companies enlisted in a foreign land or foreign soil can get through the US market through ADR. So at least that's one qualifier that Louis Vuitton is a good stock, or they pass through a certain amount of criteria in order to be listed as an ADR. So skipping on to our next topic, Square acquiring Afterpay, which is based in Australia for a good amount, 29 billion. As you can see here, they acquired the Afterpay for its buy now, pay later service to fit into the company's or Square's strategic mission. So it's a good amount. And it says here by the CFO, it's complementary merchant base, Afterpay's complementary merchant base, and its global footprint are some of the reasons why the deal poses an attractive opportunity. So it's quite a crazy amount to just spend on acquisition, right? Well, we 29 billion.
Well, the global market is so huge. That's
Mhm.
why I think they went into this buy now, pay later market, BNPL.
Right. The
So it's a good step because it's an Australian company. So they're trying to capture the Asian market. This
Mhm.
is what I'm excited about Square.
Mhm.
So the last year, we know it's just growing tremendously in the domestic market. But
Mhm.
now we are seeing that they're slowly encroaching into the global commerce.
Right. They're
So
trying to get
expect more
trying to
growth,
spread
I think,
yeah, trying to spread
spreading
their
its wings
wings.
like an eagle. I just
Yes.
saw the American eagle here.
Oh, nice. They're in Tennessee. How's the weather
Yes,
over there?
it's cool. Right now,
Mhm.
probably in the low 60s.
Right. Well, that's nice. Hopefully, one day I get to do a podcast somewhere else aside from my living room. But yeah, I'm looking at Afterpay, and some information about it is like it listed actually in this Australian Stock Exchange or Securities Exchange. Um, so it listed at the starting valuation of $122 million back in 2016, and then in May 2020, during the lockdown last year, Chinese tech giant Tencent paid about 300 million for a 5% stake, making the valuation of Afterpay jump to $8 billion. And who would have
Oh,
thought, yeah, and who would have thought like now, about a year and a few months later, Square buys the entire company for $29 billion. So,
so
mhm,
Tencent still has a stake on Afterpay.
more
Wow.
likely, yes. So 8 billion and then it jumped to 29 billion. So it's more than three times, three and a half times valuation growth. 21 billion dollars more a year and a few months later. That's just a crazy amount of valuation at this point in time that Square's paying. But I saw a report about this acquisition. Square is actually purchasing the company Afterpay through its own stock. Like it's just gonna pay the acquisition price by its own stock. So it's gonna give Afterpay, the shareholders, its own like share stock price of the, I mean, stock share of the company. So it's paying 99% stock, but it has the option to pay 1% cash. So in total, I don't think it's a bad idea because after Square has rallied so much, I think it more than doubled within the past year. They're just using their
Mhm.
stock as its own currency to acquire another company to further their growth, which is not bad. Well, I think it's really smart on this point of
Mhm.
time, especially during market all-time highs. So the buy now, pay later report by Market Insider. So we're not a subscriber to this, but but it's just here to summarize this that the buy now pay later industry will rack up about $680 billion in transaction volume by 2025. So after pay
That
alone, yeah, that's a good amount because
that's a
um
very smart move by Square,
mhm,
because BNPL is very uh, buy now pay later is very popular in like the Philippines. I know for
really.
sure.
Mm-hmm.
So if you're looking at buying some Louis Vuitton products, you
There you
can
go.
use Afterpay, right? So this
Well,
is like a
yeah.
win-win.
Yeah. And the buy now pay later business of Afterpay, which is, solely its business, it's around $16 billion as of you know, as of this point of time, according to a report. So it further will probably grow. Not bad for a company that was started in 2014 by a couple of Australians, the Sydney neighbors, Nick Molnar and Anthony Eisen. Not a bad start. The thing about it is, I think Huawei over time, buy now pay later could actually lead to some consumers taking in more debt if they're not really closely tracking their expenses. That's the only downside of it on the consumer side.
Yeah, they have to watch out for that. But
Yeah.
you have to understand people like things,
Hmm.
and like in China and in Japan, people like fancy things.
Right. Paying top
Well,
premium for upscale products.
yeah, paying for high quality, high name brand products. So
Right.
this may open up the high name, high quality brand products to the market.
To more exposure to the other consumers that weren't able to buy their products to begin with. Well, yeah, just make sure that you keep a close eye on your expenses and make sure that you'll be able to pay later when the collector comes knocking. So, all right. So for the Philippine index, some stock market review for the past week. The Philippine stock index, well, they remained flat or almost increasing at 0.78%, which isn't bad at all, comparing it to here in the US. Year to date, the Philippine stock market index is still down by 8.3%. So on our next slide, we have an interview here by OakTree's Howard Marks. Believe it or not, I've read his book, The Most Important Thing, which I would highly recommend to our listeners. It's such an eye opener how he discusses different, like the seven most important things for an investor to consider when investing in the stock market. More into that later. But here's the interview that he just had yesterday. We're going to play at least a couple of minutes of this clip, his thoughts on the market cycle.
I.e., normal. Yes. Where does that put us? And I'm going to hope we can bring up another chart here, Howard. Where does that put us on the famous Howard Marks chart of market cycles?
This is very unusual, Eric. Normally, stock prices go
Here we
up.
are.
Ah, right. Okay. Well, that's really the market cycle with the psychological cycle superimposed on it.
That's right.
But there's something else that's important, which is the economic cycle. Usually, the economic cycle and the stock market cycle coincide. Not exactly. There are leads and lags, but they move fairly together. And the high in the stock market is pretty close to the high in the economy. And then the economy turns down and the market does, or sometimes the market anticipates it and the economy does. Today, we have high stock prices by anybody's measure, not irrationally high relative to interest rates, but certainly high. And we're early in the economic cycle. That's unusual. So you could say, well, this is bad because the economy is still just the recovery is nascent and stock prices are already high. But you could say, well, yes, stock prices are high, but we have a lot of economic growth to come. It all depends on how you look at it.
Part of the
So it all depends how you look at it, Wowie. What do you think?
Well, I agree with the guy. I think because of the holdback from what happened with, the pandemic, and now we're reopening. I think we haven't seen the best yet.
Right.
So, I'm bullish on the market at this point because we
Mhm.
really haven't. I think we're reaching all record highs right now,
Mhm.
but I won't be surprised if things go up more at this point. But it all depends on the supply side of the market,
Right.
and how well we control the COVID-19
Mhm.
pandemic, especially the Delta variant that's coming up
Right.
um, in infection rates.
Right.
But the way I look at this is, this is also, well, I'm segueing a little bit here,
Sure. Go ahead.
but
Yes.
but this would also be a good test for, you know, Pfizer and Moderna's vaccine, along with the other vaccines out there,
Mhm.
on how well it works.
Right.
And we'll have enough data for a year
Yes.
showing how effective it is on different variants. But I've seen some reports on Pfizer and Moderna being 90% effective on
Right.
the Delta variant.
Yes. I just saw a report
So,
where Moderna said that after 6 months, their vaccine is still 93% effective. So it's pretty
and that's
good.
what's, yep, it's pretty good. That's why I'm staying bullish on this, because that means, less people sick, more
Right.
people at work,
Yes.
more people
Uh-huh.
producing,
Yeah.
more people
Anecdotally,
buying.
I've been working at a couple of different hospitals too. And from what I experience and from what I hear as well in other neighboring hospitals, they've slowly opened their COVID units again. It's getting packed, but this time it's mostly
Yes,
unvaccinated people or patients that are
that's
flooding
true.
flooding the rooms. So yeah, more likely as the evidence or not evidence, but as the vaccination spreads throughout the country, I think overall we'll eventually develop a herd immunity, regardless what the variant would be. Hopefully, cross fingers. Um,
Mhm.
yeah, going back to this interview, Howard Marks, look at this, almost 18,000 views just by being posted yesterday in YouTube. So usually this guy is like crowds like demands attention. Like whenever he opens his mouth, people listen, investors listen. Warren Buffett as well also sent a letter to him admiring his words and report, like annual report, like he gives it out freely to everyone who follows his hedge fund, which is OakTree Capital, and eventually kind of like urge Howard Marks to write a book. So this guy is very smart and he knows what he's talking about. So this is the book I was referring to. Most important thing. It's for sale in Amazon. This is not a plug or sponsored, but yeah, it's quite a good read.
Well, I
uh,
would like to plug another one of his book.
sure, yeah, go
Um,
ahead.
uh, it's Mastering the Market Cycle,
Mm,
getting the odds on your side. So since we're just talking about it,
the market cycles, yes. So he obviously is bullish, and we're still at the early innings. So I mean, wow, what can I say? Last week we've discussed a bunch of cash laying around, and this time, one of the best investors in Wall Street is also saying despite the all-time highs. We're still in the early innings. So as we speak, this is as fresh as last night. Wall Street stocks hit record highs again. You know, ahead of crucial jobs reports. So today's Friday, first Friday of the month. You know what it is. Fed's coming, not Fed, but the government is coming out with their jobs report. So hopefully it's a good numbers again, and we beat expectations. That way, it just means that more people are flooding the job market, and people are getting finally back to work to their normal routine, and eventually be able to provide to their families and less
Mhm.
relying on like steamy checks or handouts, which is the responsible thing, I believe.
Yeah,
Um,
26 states um, have stopped their what do you call this,
this
unemployment support.
um, unemployment.
So
Mhm.
50% of the US
Exactly, a little more than
has,
that, 26. Yeah.
so now we're gonna expect more people coming back to work now that they're slowing down on their assistance, unemployment assistance.
Oh, well, that's a good sign. At least people are, we'll find out by 9 a.m. Eastern Standard Time what the result is of that halting of steaming checks or assistance provided. So for the
Last
week,
week was slow, right? Last week was slow.
right,
The
like
jobs report,
the
uh,
expectations,
yeah, was
were
lower than expected. So
right.
less people went back to work.
Hmm. Oh yeah, you mean last previous report? Yeah.
Yeah, on the previous report.
Yep. So for the week, we see right now for globally some of the largest world stock markets, S&P 500 at 0.77% or nearly 1%. Not far difference from the Philippine stock market, which is albeit a little smaller. The top performing for the week actually is India, Nifty 50. They just reached all-time highs. Oh my gosh, like three and a half
Mhm.
percent almost, or just
That's
one
a
week.
good sign.
This is what
Yes.
Nasdaq was doing in summer, early summer, June or July, when the rotation to tech has started happening from like reopening stocks. So India's all-time high. You can see here Nasdaq a little about 1.5%. Dow Jones about 0.5% for the past week. Well, for year to date, I would say since January of this year, S&P 500 outperformed everybody else globally in terms of returns in stock market indices, almost about 18%, and followed closely by Nasdaq and Europe stocks, and then the Nifty 50 or India's stock market, which is sort of interesting. And then the least performer, of course, is Hong Kong or Hang Seng Index, which have suffered from some government mandates to its industry, specifically the Chinese online education market. And also, not far from it, Tencent and Alibaba, like the big tech. And not to forget Didi, the ride hailing company that just went public, which might consider delisting, but they refute those claims. So, yeah, for the cryptocurrency, for the past week, we lost 5.5% on Bitcoin, and interestingly, Ethereum is up 6.7%. Well, contrasting, usually they go in tandem, all of them, but interestingly, they're in contrast this week. And then specifically, now we're going to the industries and the stock market. Technology is back in groove. It's up 1.8% for the past week. And energy, like inversely proportional to technology, lost 1.8% for the week. So if you have oil and banks, I mean, if you have oil in your portfolio and then you also have tech in your portfolio, if you have 50-50 on each of those industries, you might have gained like about flat, like 0% for the past week. But that's because you're well diversified, as I would say it. So market indices and reopening place. So I have here a chart with a lot of like lines, but just to summarize it briefly, we have the index or ETF JETS, which includes all the airlines in one ETF. So these are what I consider market reopening place because people are flying back, So the Jets ETF from the start of the year till August is down 5%. Interestingly, because supposedly we're open, but look here closely, they started losing momentum of the upward momentum back in June, summer. This is when we started our podcast. While we we were actually discussing the slow inflows going in to tech away from banks and all that. So I think investors are voting with their pockets, and you know airlines aren't benefiting as much. And in comparison, Nasdaq bounced back up mid-May to all-time records recently. So believe it or not, it looks like Nasdaq is an index of tech companies is still gaining traction. And for the past month, as we have been discussing, Nasdaq is climbing up. It's up 3% compared to the Jets and PAJ and energy. Energy is actually down 10% within the past month, despite the reopening, which is quite interesting. Banks in conglomerate or altogether are up at least 1.6%, but energy is down 10%. So PEJ, just to briefly tackle it, because it's also one of the reopening tickers, as I would like to point that out. PEJ is Invesco Dynamic Leisure and Entertainment. So in its portfolio, in its top 10, includes Yum Brands, Starbucks, McDonald's, Walt Disney, Yum China, Expedia. So these are the reopening plays. They're also down 5%. So looks like investors or Wall Street looks like they're betting their money or they're liking technology at this point in time, and also some industrials, but not they're shying away from reopening place per se. So quite an interesting turn there.
Well, wait a few weeks. Maybe things might go in favor of energy
Right.
since Saudi Arabia, UAE just reached a compromise on increasing the oil supply, boosting the supply in the market.
Oh, okay.
So we may just be behind that boost. So
Right.
maybe in a few weeks we'll see some increase in energy stocks.
Well, my thing about that is the more supply that they're gonna produce outweighs the demand. So the problem is, I think investors are fearing the ongoing rampant infection rates that's happening with the Delta variant. Therefore, they're thinking that there might not be as much demand. And now Saudi's coming out with more supply that could play in the dynamics. I'm not sure. It might lead to a
Well,
flat reaction or a little spike, but we'll see.
yeah, the way I look at it is
Mhm.
since we're increasing, well, there's already an increase in demand for products, commodities.
Mhm.
So we need to start shipping all these things here in the United States for one, and there should be an increase in usage utility of these oil
Oil
products.
products, yeah, like
Yeah, to
the
meet the demand.
petroleum. Mm.
So I'm just thinking we're just slightly behind on that curve.
Yes.
So I'm thinking maybe a few weeks you'll see an increase in
Yeah. Yes, like
in
uh-huh.
interest in all stocks.
Like Howard Mark said, we're in the early early stages
Yes.
still.
Oh yeah,
Not to
yeah,
forget.
exactly.
So yeah.
Exactly.
So we're gonna play a clip here. This was done or posted on August 2nd. It was an interview by CNBC to Tom Lee. His thoughts, what's gonna happen this month.
August getting off to a cold start. The S&P 500 and Dow getting hit in a late day sell-off, while the Nasdaq eked out a gain. Stocks getting tripped up over worries about Delta variant slowing economic growth. But our next guest believes it'll still be a winning month for stocks. Let's bring in Tom Lee, head of research at Fundstrat Global Advisors. He's also a CNBC contributor. Tom, great to have you with us.
Thanks.
What makes you so confident about August?
Well, I think markets are anxious about two things you already addressed. One is the Delta variant across the US and the fear that this could trigger new lockdowns. And the second, I think, especially coming into play today, is that the 10-year continues to sink lower. So despite expectations across the street for inflation and higher real rates to drive higher nominal rates, the 10-year is sinking. So I think investors are pretty nervous about those two things. But I think between now and month end, we think the odds are high that the Delta variant could peak. One of the reasons we believe that is hospitalizations incrementally for COVID are actually beginning to roll over. And the second is that, I think the 10-year is sort of at an important juncture here. It's near the 100-week moving average, and it looks like it could potentially be reversing. So I think you could have higher rates into month end or Delta rolling over, and both would trigger a risk on rally.
The Delta rolling over, and we've seen the charts of the UK, the cases peaking. We've seen
So he's saying that, it's either of the two or both of them could happen, both the rolling over of hospitalizations and the 10-year. So what do you think, Wowie, about this another positive sign that might happen by this month?
Well, looks like, well, I have a tendency to be very optimistic.
Mhm.
So yeah, so I'm seeing a good trend. I'm seeing a good trend, just controlling the rates of infection. So keep masking, everyone. And if you're still hesitating about the vaccine, or fearful about taking the vaccine, do your research, do your homework, weigh your risk. Some people that I know that have been hesitating to take it for months finally have taken it after seeing their friends or family members that have taken the vaccine and finding it safe.
It's like a snowball effect, I think. Like once it, dissolves your fear, then you build a conviction and you would, hopefully you get the vaccine. That way you're protected and your
Oh yeah.
relatives too. So we're jumping onto our next topic. It's the investor sentiments. So we're always looking at the AAII investor sentiment. This is as of yesterday, fresh from the oven. So nothing has changed, Wowie. From last week, 728, 36.2% bullish. As of yesterday, 8-4 when they published it, the survey led to 36.1% bullish. So not much change. But at the bearish point of view, from last week of 24%, there was an increase in bearishness at 31.7%, which is
no, I tend to add the neutral
Mhm.
ratio to the
Oh.
bullish ratio.
Yeah. They're like tilted more to the bullish side, right?
Yes.
Well, I guess, yeah, but it's still a little high in terms of historical average and pertaining to the bearish sentiment. They're 1.7% high compared to their historical average of 30.5%. So that's something to keep an eye on. Another chart here says fear and greed index. So currently now we are at 34, whereas a week ago we're at 30. So fear, like the AAII sentiment had indicated, has slowly increased a little bit. The extreme greed and extreme fear chart, it's a little bouncing back up, but it's still very much low between like average standards. The Bitcoin fear and greed index now at 52, compared to last week's 53. So it's still about neutral, about half. So in terms of the Bitcoin sentiment, I think they're relatively steady at this point in time. So I don't keep track of the prices, but I do keep track of the fear gauge index of the Bitcoin, because whenever that suffers, it kind of reflects on the retail side of things, which is being exposed in the stock market investing. So the volatility index for the past 5 days has fallen at least 7.9% or 8%, which means there are not so much volatility or up and down in the markets for the past week. In contrast to what the other sentiment surveys has indicated, that fear has increased. So not it always not coincides. It just sort of rhymes, I guess, in terms of the sentiments and the flow that we watch out for every week. So this is a weekly information that's being published by Bank of America. So we are seeing flows going into ETFs still compared to last week. So from July 26th to July 30th, ETFs receive a bunch of flows compared to its 4-week average, almost reaching $2 billion compared
So
to its
what does that tell us?
4-week average. Yeah, I think people are still getting into the stock market,
It's
plow,
bullish, right? So we're
plowing,
still
yeah,
bullish.
plowing into the ETF for sure. But yeah, interestingly, while we look down here, there's
Mhm.
a outflow from tech, nearly, let's say 700, 600 billion outflows from tech. But if you're going
Mhm.
to ETF and if you're going to the VOOs and the VTIs of the world, more likely you're still going to end up having shares of Apple and those tech companies.
You'll still end up indirectly investing in tech. I think
Exactly, that's a key word. Indirectly, you're still exposed for some reason for tech companies because they're the biggest of the big like stocks
mhm.
listed in the stock market.
Yeah, and I think the weekly earnings last week has something to do with the outflow on tech. So people are probably taking profit and expecting more from the tech giants.
Right. They're still gonna be delivering for sure. I'm 100% confident on that. A little slower, but you just have to read between the lines. Facebook is saying there's gonna be slowdown. Google won't say their projections, but obviously they won't be able
Yes.
to have that jump start from like a low base back in COVID lockdown comparisons. So definitely growth will slow down. FactSet, as we've discussed in a previous podcast, already sees a good drop from 40% earnings growth to 10%. So if this is already priced in the market, so I think at least we'll be able to suffer at least a little less of a drop. Hopefully not, we'll see. But any drop is a good buying opportunity at this point of time, uh, as I already had proven in the past couple months. So this next chart here, it says the unemployment benefits. So it just says here, that states here like how much an unemployed individual could earn or benefit from the government handouts. So regular state unemployment insurance is $1,000 per month. 300 weekly unemployment bonus is $1,300 a month. Food stamps $365 a month. Child tax credits, which Biden has recently approved of, $600 a month. Earned income tax credit $400. In total, it's almost $3,700 per month if you don't have a job. So as why we have pointed out, at least 50% of U.S. states or at least of the United States have already sort of like curtailed this type of payouts to unemployed individuals. And the pulse of the economy. So I think this is a good way to track broadly what's going on with the U.S. Economy, not just the stock market. So every now and then we're going to pull these charts up. It's a weekly update provided by Barron's. So gross domestic product, it rose in the second quarter by 12%, which is really strong. Personal income rose 2%. I guess what I'm trying to point out here is the personal savings rate. So from a year ago, it was 19%, but it dropped almost more than a little over 50%, 51%, down to 9.4%. But it's still pretty high up there. So people are now like diving into their savings to pay for expenses. So over time, savings alone cannot support like your daily expenses for sure. So with in addition to the curtailment of unemployment benefits, I think more than likely, in comparison to the weak jobs report we had last month, people would probably start showing up at work or applying for jobs, which would eventually be helpful to the overall economy. What do you think, Wowie, in terms of this event? Or Wowie, I think you're
Oh,
you're on
sorry.
mute.
I'm
Yeah, go ahead. You go ahead. Sorry.
Well, expect more consumption um, from people.
Right.
So should see increase in consumption of commodities, you know,
Mm-hmm.
and vacations, vacations, family holidays,
Yes.
coming up, Thanksgiving and Christmas is coming. I know
Oh, the big holidays. Yes, sir.
Mhm. I think
So,
people are saving up for those holidays
mhm.
to get back with family,
Yep.
you
And
know.
they're definitely dipping into their savings at this point in time. A 51% drop, that's quite a good amount. As you can see here
Mhm.
as well, Wowie, the personal consumption, it's not trending down. It's actually going up. 16% rise, personal consumption in billions, in terms of billions, now at
Mhm.
13.7 billion compared to last year's 11.8 billion. So people are spending.
Mhm.
Also, as well, consumer confidence that we are closely tracking. So definitely it's way up there, 129% compared to 92% last year, 41% rise. So this is the data that was published by our government, the US gross domestic product, which entails our economy, basically. So as this GDP growth, as what the economists would say, goes up or remains flat or grows up, US economy will continue to grow. And as we have pointed out on our previous podcast, this is mainly um, like produce or as a result of consumer spending. As long as consumer spending is strong, economy will grow. So US GDP grew 6.5%. And as you can see here, most of it is from personal consumption, which is 15.7 billion, or it grew 11.8% or 12%, which is a good sign in terms of reflecting what's the status of our economy. So another chart here for our listeners. This is the Chicago Fed National Financial Conditions. Quite a word, quite a jargon, but it just means the financial conditions. So the higher the chart goes up, the more tight the economy or the financial condition is, or so it's tougher for people to get by. The lower it goes down, the more easier or the financial condition is. So we're taking a closer look at 1 year. It's been slowly going down, but as of July 16th, we are showing some signs of going up here. So this is a relatively upper highs. So we're going to take a closer look at this. It just means the index for financial conditions for the money markets, the debt and equity markets, the shadow banking systems here in the US. So it kind of weighs the sentiment broadly. So we're looking at sentiment in the stock market specifically, but this one is the condition of the overall like money markets in the US. So it's slowly creeping up, but we'll see how it goes. It's still a lot less compared to last year. That's what I'm just pointing out there. So loans and leases from commercial banks. So just a couple weeks ago, we were seeing the banks were not being in a good trend just because insurance or interest rates are going down, so they can loan at a higher rate, less profits. But loan leases are slowly increasing as well. Maybe that is contributory to why the financial condition is increasing as well. So it just means that people are or businesses are trying to loan from commercial banks. So business is starting to pick up. Um, Meanwhile, commercial in industrial loans is still slumping down. So let's see what this means. I guess commercial and industrial loans are for um, investment, also used for those bigger companies that partake to expand their business or capital expenditures. So comparing it to loans and leases in bank credit, so these are, I would say, the retail or like the more of the consumer type or the small business type. The commercial industrial loans sounds like it's for the bigger banks or bigger companies. But as we have discussed last week, these people or these companies have a lot of cash. stashed in their balance sheet. So that may be the reason why they haven't like increased their demand from overall from the banks. And this is just a personal savings rate that we've briefly discussed is down to 9.4% from all-time high of 27% just back in March of this year. It's quite interesting now that people are dipping into their savings.
One thing I'm seeing too is a correction in the housing market. There's not as many buyers right now. I
Right.
think they're voting to say, hey,
Excuse me.
that housing price is too high, and
Exactly. Excuse me.
we want something more fairly priced than that.
Right.
So what I'm gonna see here is an uptrend in home buying
Mhm.
by next year, if not late this year, but most likely, early next year in the spring.
Yes.
We should see another surge in home construction and home buying.
Mhm.
And
You're
that's my opinion.
yeah.
Comment 6 months after if I'm wrong, or 9 months after if I'm wrong.
We're definitely gonna take a closer look at that in a few months. Like you said, Maui, new home sales, thousands of units had dropped at least 19% as of last week. Data provided by Barron's from 839,000 units being sold down to 676. So definitely a slowdown in the housing market. A little slowdown now. Consumer confidence, we briefly discussed this. It's still, hovering above 120, 129% to be exact, by the provided data provided by the conference board, which indicates that the consumers here in the US said business conditions are good. So business conditions are still good. So it's still supporting our economy at this point in time. So, like you said, while people are taking vacations, but it looks like there's one airline. Well, I guess this is not solely um, pointing out Spirit Airlines here. I know Southwest also experienced some sort of cancellations, but Spirit Airlines takes home the cake for canceling more than 1,700 flights since
Is
last
that
weekend.
related to like labor issue?
Yes. So, according to the airline, they blame the issues on a combination of bad weather, staffing shortages, and technology outages. Wow, that's 1,700 flights. Just imagine you can't get to where you're wanting to go, and you already have booked all your hotel stay and trips, and people are just rushing out to enjoy this few weeks of last few weeks of summertime, enjoy their time with relatives. But yeah,
It looks like it's more of a labor shortage.
demand is definitely still there for people to go and spend quality time with their families. So this is just a brief review of the oil market we briefly discussed. So I would say here, oil inventories jump as gasoline inventories plunge due to sky high demand. So just the title alone says a lot. So there's a sky high demand of oil. It says here, well, we're gonna look into the chart of oil price in a little bit, but gas prices rally, of course, on oil's recovery. So the most common U.S. gas price, it's up $2. It's up at $2.99 a gallon. The states with the lowest average price in this point of time is Mississippi, Louisiana, and Texas, $2.82 per gallon. The states with the highest price of oil, obviously, is California, $4.35, Hawaii, and Nevada at $3.98. So definitely, as shown in this chart, definitely bounced back up from a low of $1.74 back in April 2020, now to almost almost doubled at $3.19 per gallon in terms of like average US gas prices here in the US. So definitely there's demand in oil. And like you said, I think the Middle East countries known for their oil supply, are now thinking, hey, we need to catch up to generate more profit. So they probably see more demand in the near term. That's why they have agreed to finally boost some of their supply. So here we are on our another interview. This time from BlackRock CEO. This is Larry Fink. As you might have known for our longtime listeners, we have been listening or we have been discussing BlackRock's products, the ETF, right, Wawi? I think their
iShares.
products are iShares. They're the largest or second largest ranking, close to Vanguard, which has like the total stock market index ETF. This is for people who just want to invest passively and just on a monthly basis or quarterly basis. They just dump in all their money buying this ETF to get exposure to the stock market. So in this interview, it says BlackRock CEO warns of the silent U.S. retirement crisis. Let's play the clip.
Type growth, and savers are continuing to be just slammed. I mean, are you not worried about the Fed's action at this point? I don't see how they get out. You just said that if inflation is probably going to be higher, they're stuck in this box where they can't really stop. And the more they don't stop, the more savers get hurt. So what's the answer long term?
Hey, Joe, I think you framed it really well. And I've been talking about that for years, about the silent crisis of a retirement. And unquestionably, as central banks keep rates low or negative in Europe, the savers are getting slammed. And you're absolutely correct. Asset owners are the biggest beneficiaries of monetary policy. And this is why I think a year ago, 2 years ago, I talked about we need a more fiscal stimulus and maybe less monetary stimulus. And so there is no question savers are being slammed, using your word, and that is a persistent problem, and that will remain a bigger problem. Much of this has to do with, this is one of the reasons why we're seeing many of the savers are now more confused. And I think some of them are now finally entering into equities and other asset categories as a part of it. I think, as you remember on your show a number of years ago, I was asked, what should be your asset allocation? I've always said 100% in equities. Not that I predicted where monetary policy will be, but unquestionably, we are going to have to address what I would call the silent crisis of retirement. People are going to have to, unfortunately, if whether they like it or not, they may have to work longer because they're not earning the same returns on their savings. On the other hand, if you had a balanced portfolio over the last year, you've done quite well. You may be being hurt on your bond or cash allocation, but in your equity allocation, you've done quite well. And for those who own homes, obviously, they've been a big beneficiary of rising asset prices.
Shepard Smith.
Whoa, what do you think,
Yes.
Bobby, about that?
Well, I think we're gonna see it, right? This is like a short-term prediction.
Yes.
That's why I'm looking at it. So this year, next year, baby boomers are retiring.
Mhm.
And if they have not saved or have not invested, they may have to stay employed
Right.
one way or the other, or
Mhm.
have some kind of gig going on to support their lifestyle.
Yeah, a couple of things that I want to highlight in that interview is like, if you ask him a couple of years ago, he said he would have he had recommended for you to go all in the market, 100% in equity. It just means equity is stock market for listeners who are quite not familiar of the term. So, I mean, in terms of like his conviction, I mean, he could have his own bias. I mean, he's the CEO and chairman of the world's largest ETF. Definitely, he'd benefit if people still keep buying his, ETF. We just showed earlier, a few minutes ago, people are getting into ETF, so more profit for BlackRock. But I mean,
Yes.
he has a good point. Like, if you're not investing in stock market, you're getting crushed because of the inflation. Inflation is gonna be up around 3%. Savings rate is gonna be down less than 1%. So, in summation, you already are already defeated on that aspect. So
Yes,
unless
and
you
if
haven't
you're
had the exposure to the
hedging,
stock market,
exactly, Mark, and if you're hedging for quite some time, like
mhm,
doing the 60/40, um, keep doing that 60/40 right now, in my opinion, if you're close to retirement, might be more harmful, um,
right,
because of inflation. Um,
exactly. So
it would be a negative, um, dividend if you get into bonds right now because of the yields being so low.
mhm, yeah,
Um, so where else would you go, right? Well, I
he,
guess you can like go into
uh
real estate or something, be a landlord or something,
right.
start renting.
Well, hopefully for the boomers, like you said, Larry Fink said, like those who are who own assets at this point in time, who are homeowners, have benefited at least because of the rising house prices, and they have more equity from the from owning. But keep in mind, this guy, he said 100% in equity. That's his recommendation. So keep that in mind when you still hesitating to invest in the stock market. So proceeding on to our next. So as briefly tackle Alibaba and what's happening in China. So invest this we gone through briefly last week. Investors lose $1 trillion in China's wild week. This was last week, right? So we're gonna fast forward to this week's some articles reflecting this. Big rethink ahead for US Chinese listed stocks after ugly July. So Nasdaq Golden Dragon China Index posts worst month since 2008. So the sell-off led to the worst month performance of the Nasdaq Golden Dragon China Index, which contains obviously the Alibaba and Tencent of the world. This is as of July 30. So a lot of selling that has occurred. US listed Chinese stocks plunged 22% in July, the most since 2008. This led to the panic sell. Oh, I'm not saying panic selling. I guess Kathy Wood prepares whatever her research concludes, and then she does whatever she needs to in order to reach the alpha or beating the market. So she pulled out at this point of time, selling everything in the stock market except for a KE, a company named KE something, which we didn't, tackle because it's just a little less percentage in her holdings. So meanwhile, which is interesting, foreigners are buying China stocks after tech education sell-off. So this is an article from Bloomberg on August 3rd, updated on August 3rd. Overseas investors have loaded up on Chinese stocks by the longest stretch since late April. So
An
this,
opportunity. Things
yes,
went down, so they're buying the dip.
yes, exactly. And what kind of brings to mind reading this sentence alone is, I guess, buying the dip, Huawei, is also happening elsewhere. It's not just in you. It's a phenomenon that's has no fear. People go to where the opportunity is or where the drop is happening. So
They're looking at the price movement, I think.
yes, foreigners bought a net 21.5 billion yen or yuan or 3.3 billion US dollars over the past 5 trading sessions via Shanghai and Shenzhen. I mean, that's a lot of money dumping into China, whereas, the more famed investor Kathy Woods has been pulling out. So could that be the indicator that the market has already bought them overseas? So we're not sure. But China's manufacturing growth. So for those who are more skeptical of China, PMI, Purchasing Managers Index, which are closely being tracked by Wall Street. So if this index drops less than 50%, it's a warning sign. If it's above 50%, it means it's expanding. The China economy is expanding. So at this point in time, as of July, fresh from the oven, July 2021, they reported 50.4%. So the economy in China, it's still expanding or growing. So I mean, I think nothing to worry about here. Well, although I posted in our messenger group, right, just a couple of days ago, that I think 50% of Chinese provinces have now some sort of like engage in some sort of lockdown or parameters because of the COVID variant spread. But they are the first ones in the field. They know what they're doing. COVID variants leads to hospitalizations, and hopefully, they're able to also tackle this disease accordingly that way.
Yeah, it
Uh,
also leads to more innovation,
right.
product innovation and service innovation.
Exactly. I think Charlie Munger last month, and we're gonna play that clip maybe in the future, but Charlie Munger, as of recently, last month, a couple months ago, in an interview, said that when he looked at, I think through Zoom, he fell in love with Zoom. He said during the interview,
Oh, yes.
because he can now see what's going on in other places, other countries as well. He had seen factories in China having more robots instead of workers. So that's something to watch
That's
out
true.
for. So
Mhm.
I mean, purchasing, as long as people have demand buying products, the Chinese economy will still keep growing. So these are just some Google images for Alibaba headquarters. Definitely, they're spending on their employees, their company. It's not just all fluff. Um, Alibaba is definitely making its way despite the government entanglements.
Yeah, and in
Um,
contrast of China's growth, if you look at iShares EWJ,
mhm,
Japan ETF, it's relatively stable. There's not much growth there. Maybe slightly.
mhm,
So you can see Japan's market is rather stable,
right,
and not as volatile as the Chinese market, as of what happened last year from the Wuhan virus.
right.
But I'm still thinking, if you look at the Japanese market, look at um, some of their car companies, some of their battery companies.
Mhm,
Uh, just looking at tech. Still
right,
look at Japan's influence on tech.
right. They're more of their robotic technology. So now we're looking at Alibaba stock. So for the past for since January of this year, it's down quite a good amount, 12.5%. So from a high of $270 reached in February, it came crashing down to just $199 per share. So this company is listed as a ADR, or American Depositary Receipt, similar to the Louis Vuittons of the world, like what we discussed earlier. So it's based in, let's see, China, Hangzhou, China. So so
Mhm.
looks like in terms of their recent report, um, they actually reported, oh, let's see, they missed earnings Wall Street estimates for the first time in 2 years. So that sent their stock a little lower as a result, including the ongoing trends that the China has hit hard on the industry itself, like more supervision or whatnot. But we're taking a closer look at the numbers instead of the noise, as I would like to label the something that's outside the company that they don't even have the control, like what the government's going to do. So their revenue from June 2020 of last year, this is during lockdown, was 21.8. But as of this year, June, the revenue spiked to 31.9 billion. So it's still quite a difference, 10 billion difference, but still it missed Wall Street estimates. I think as expected, they were expecting a lot more from Amazon, Facebook as well, which we briefly discussed in the other episode. So that's
They
why
should
they're
be looking at Alibaba, right?
yeah. So yeah, now net income for the company is 6.6 billion. So it's not just sales for Alibaba. They're generating profits, good amount, 6.6 billion as of June last year. And they generated, well, they've this is what missed Wall Street estimates. It was flat. 6.6 billion last year and 6.6 billion this year. That's why Wall Street kind of disliked the stock after it reported the earnings. But yeah, looking at their stock price, they dipped almost 25% compared to S&P 500's performance. I think one thing to point out here is going back to its balance sheet. This is what attracts me the most um, to the company. So I'm not like solely looking at the balance sheet now. I'm looking at its growth portfolio or its sales. But one thing that I really like in a company is its rich cash in its balance sheet and then low debt. Because whatever happens in the economy, as long as the company is able to sustain or has a lot of cash in its balance sheet, they can survive. So this company, Alibaba, had 75 billion in cash as of June, and its debt had 28 billion. So their net cash, they can actually pay off all their debt right now and still have about 47 billion in cash. So
So for
this,
our listeners and our watchers,
Mhm,
this is a very important point.
right?
Looking at cash and debt on a company's financial statement. I think those are the two things that you would look at,
Yeah.
before you buy a stock.
Yes.
One
I'm
of
not.
the things, but those are the two
Mhm.
main things.
Yes, as long as the company has good cash and it's growing. The, never mind the earnings. I mean, the company, not never mind the earnings, but the company generates earnings. It's just flat, and
Mhm.
they're definitely looking into, like,
You have to look at what phase they're in too,
mhm.
when it's flat like that.
And keep in mind, just one point in last year, October 2020, Alibaba's stock price was trading at $317 a share. So
Mhm.
it dropped a lot already. It's dropped about 37% up to this point in time. So I'm not saying that the stock will pop back up to 300 by tomorrow, but just definitely keep this in mind. That stock is trading at 24 times PE as well. So
Yeah,
not.
and
Mhm.
look at current government policies, you know, regarding China.
Right. So I believe, it's just only a matter of time when we have just briefly discussed, money is plowing back in silently, as we've noticed. They're plowing back in China, fearless, just going straight through the fire. Hopefully, that's not cash going through the fire, but I'm also exposed personally. I have Alibaba shares, and to be transparent, I've been buying last week a couple of days in a row, a couple of $100 here and there, just by Alibaba stock. So our last video clip for the week. This is still Howard
Well,
Marks. Mhm.
before
Oh,
you go on the
yes,
clip,
sir.
Mark, I think I'm also FOMO on China, but I
Mhm.
do have Billy. Have to
Uh-huh.
declare to our listeners and watchers, I do have a Chinese stock called Billy. It's like the
Right.
YouTube of China.
YouTube.
But I am FOMO on Tencent and Baba, so I might
Mm.
follow your lead. But don't
I
let
al-
this influence our watchers and listeners. I'm
right.
gonna watch it a little bit more and then maybe dive in.
Right. I also have Tencent. I think those are the biggest, like, really established companies. I don't see them being delisted because that will probably lead to a massive sell-off. Unless,
Exactly.
unless,
Why would they?
yeah, unless they just really, the government, just Chinese government, just really wants to, curtail the investments that's been ongoing in China by foreign investors. But yeah, last week also I saw an article where the Chinese government actually invited the Wall Street banks, some of their representatives, to their headquarters to discuss
Yes.
what's happening in the sell-off and trying to calm things down. And all they want to do
Mhm.
is improve their infrastructure, and they don't want to be, all they want to do is improve their market. I think nothing's going to come out worse from this unless you fear the worst and act on it and just sold all your stocks. So we'll see. So this is the last video we have for the week. This is again Howard Marks and what he thinks about what the Fed needs to do in the coming future. All right, let's play the clip.
Stock prices are high, and of course, interest rates are low. It's because of central bank monetary policy.
Yes.
Your latest memo, Howard, is called Thinking About Macro. So I have a macro question for you.
Yes.
William McChesney Martin famously said it was the Fed's job to
Oops, sorry.
take the punch bowl away just as the party gets going.
Right.
If you were Jay Powell, the Fed chairman, would you be taking the punch bowl away now before the party gets out of control?
The most emphatic thing I want to say is that I am not Jay Powell. I wouldn't know how to do his job. I
Jay
don't
Powell.
want his job. I don't claim to know better. I would lean toward leaving the markets alone. I talk in the memo about naturally occurring interest rates.
In other words, non-interventionist.
Yes, but so you might say, well, then you leave the punch bowl. No, they have delivered the punch bowl in their activist role. And so I would like to see the punch bowl removed somewhat so that interest rates are what the economy and the participants want them to be, not what the Fed wants it to be. So, look, they had a hard time raising rates after the global financial crisis. And each time they tried, they got a tantrum. And in early 19, they backed down. I think they missed the opportunity. And I wouldn't want to miss the opportunity this time to raise rates as the economy is very strong. Now, they claim it's not strong enough yet on the job creation side. But I don't say today, but I say, let's not miss the opportunity to let rates float back up.
The central bank appears to be very afraid, fearful of another tantrum. Are tantrums okay?
You can't. It's like with your kids, and you tell them they have to stop with the screen time. They throw a tantrum. As a parent, we can't be afraid of our kids' tantrums. And the Fed can't be afraid of investors' tantrums. The Fed has to do the right thing for the economy. Its job is not to make money for investors. It has to do the right thing for the economy. When the economy is strong and unemployment is declining and inflation is threatening, I think you have to let interest rates float back up. You have to stop with the emergency measures and try not to be too late.
So very insightful interview there for Howard.
That's experience and wisdom right there.
So
and he put it in he's just kind of put everything in there.
The right mindset. Like the Fed shouldn't be afraid of a tantrum. It's like taking away probably an iPad or something from the kids, and a market reaction once the Fed starts doing its thing, raising the interest rates up, might lead to a sell-off. This is what I'm thinking, and I think you got to let it play out. Obviously,
so
try not to control the interest rate so much or something like that.
Picture, exactly, Mark. The big picture is fear. So there's a big kind of fear in the market, but if you don't let it do its own thing, how would you test your thesis? I mean, how would you know, right? So he's right.
Yeah, hopefully,
and I'm all for that too.
Yes, I totally agree. I think let the free market rule, do what you have to do to prevent banks or companies from collapsing. But when you see the growth rates coming up, you need to probably act on it, or not act on it, just let the free market dictate. But we'll see how Jay Powell would tackle it, especially now we have the jobs report coming up in a few hours. So I guess for next, before we tackle on the next episode or next week's topic, do you have any quote for the week for us, Wawi?
Yeah, I think I do. But before I do that, I would like to share a message from one of our listeners.
Oh, sure. Yes, go ahead. Yes.
This is from my friend, Michael Parcon.
Hey, Mike. Thank you for the... Hey, Michael. Thank you for the feedback. Yes, sir.
Yes, thank you, Michael. I've watched 4 of your videos the last 8 hours. Oh my gosh, he's doing us like Netflix.
8 hours. Oh my gosh. Thank you so much.
And he said, I've learned more from you guys versus 10 days of reading. Keep on uploading. I feel less stressed in inpatient care. Okay, anyway, he's talking about work now. But anyway, he's enjoying our podcast. And I've talked to him before. He was planning on, he was asking me about books to read and stuff. But I kind of tried to segue him a little bit on watching some YouTube videos on how to just, kind of get the gist of, learning how to invest. Definitely. It's the faster way. There are good books out there. He's still a book reader, but I think I've learned a lot from just talking to you, Mark, and, talking to Stephen and being in the group. So, so I'm thinking, continue book reading, but, keep yourself engaged in communicating with people that may have some experience, investing. And again, thank you very much, Michael. for your comment today.
Thank you so much, Michael. We appreciate that a lot. That's what just keep us going. Because right now, we're me and Wai, we share the same passion, definitely, in investing in finance. So this will
Mhm.
certainly help us improve better or make more content, like at least once a week, and deliver like facts instead of just throwing out random opinions and predicting what's going to happen. So I believe this is the what builds your conviction, why you have to stay invested or why you have to keep investing. I mean, you're investing in yourself once you're spending your time listening to our podcast. You're trying to develop this like knowledge or wisdom over time. So we truly appreciate it. I truly appreciate that. I appreciate your feedback, Michael Parkon. I think he's in the group too, right, Wabi?
Yeah, he is in our group.
All right. For
Yes.
yeah, for
Mhm.
our listeners, if you're hesitating, don't be shy. Just reach out to us. We'll definitely add you in the group. That way, we tackle your ideas. If you have stock questions or investment questions, we can as a group form, conclusions or form ideas what to do about it. And we can actually look into the company. We could dissect its numbers and all that. So yeah, I'm gonna play this thing right now. Woo, woo. So for next week, we're gonna take a further deep dive in one of the ADRs as well in China. While we were gonna take a look at Tencent, what the Chinese government called at one point opium for the mind that sent its stock diving.
Gaming,
Yeah, gaming. They don't like
gambling.
what Tencent's doing to their kids because they're sending their kids addicted to their smartphones. But yeah, we're gonna tackle a closer look on that, and we are probably gonna be also discussing some of the market sentiments at that point in time. Well, Wawi, thank you so much for coming on. For our listeners who have questions, just shoot us an email at markuwawishow@gmail.com. Or if you just want to say hi, send me a text or message at marku_dpt at Twitter. That way we could add you in our Facebook Messenger as well. Listeners, we truly appreciate each and one of you. That does it for this episode. Remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark Yu signing out.
And this is Wawi Santos. And don't forget, wealth is the ability to fully experience life.
All
Have a good
right.
day, everyone.
Have a good day, guys. Bye bye.